Hey everyone, welcome back to the Jeff Trap podcast. Today we're talking about something most business owners completely stop thinking about during the summer months. And you know what? That is taxes. The weather gets nice, the kids are out of school, people start traveling, going to barbecues, taking vacations, maybe attending some trainings and conferences. And honestly, tax planning usually gets pushed to the back burner until year end. But here's the problem. Some of the best tax saving opportunities actually happen during the summer. And if you wait till November, December to think about taxes, many of those opportunities are already gone. So today I want to walk you through several hidden or overlooked summer tax deductions and strategies that business owners and real estate investors and entrepreneurs should be paying attention to right now. So what we're going to cover today, and like I said, it's a jam-packed episode, is hiring your kids, turning summer camp into tax savings, Roth IRA opportunities for kids, travel deductions, conferences and seminars, vehicle and mileage deductions, the wrapping the weekend strategy, meals versus entertainment deductions, and why proactive planning in Q2 and Q3 matters more than most people realize. So let's jump right in. So one of my favorite summer tax strategies is hiring your children in the business. Children between the ages of 7 and 17 can earn up to $16,100 for work performed in the business this year. And this is one of those strategies that sounds too good to be true, but when structured properly, it's completely legitimate. If your child is doing real work for the business, maybe social media, filing paperwork, cleaning the office, helping with content, organizing inventory, video editing, photography, whatever it may be, you may be able to pay them and deduct those wages through the business. Make sure you pay them a fair market wage too. So this is where it gets really interesting. That income shifts from your higher tax bracket down to your child's lower tax bracket. In many cases, kids can earn thousands of dollars federally tax-free because of the standard deduction. And instead of paying your child out of your personal after-tax money, you're paying them with business dollars that might be deductible. That's a huge difference, but here's the key. The work has to be legitimate. The pay has to be reasonable, and documentation matters. You want job descriptions, keep track of their time with time logs, payroll records, and actual work being performed. You know, just don't throw your 8-year-old on payroll making $40,000 a year as vice president of operations. That's how people get in trouble. We don't want you to get audited, but done correctly, this is an extremely powerful family tax strategy. Now, once those kids have earned income, there are additional planning opportunities. For example, maybe you can use those wages to help pay for summer camps, private golf lessons or tennis lessons, sports programs, tutoring, or even future college expenses. And another big opportunity people may overlook is the Roth IRA. If your child has legitimate earned income, that's W-2 income, they may be eligible to contribute to a Roth IRA. Think about how powerful that is, right? Imagine your teenager contributing a few $1,000s into a Roth IRA starting at age 14, 15, or 16. The amount of long-term tax-free growth that can create over a decade is huge. You're not just teaching your kids about work, you're teaching them about investing, wealth building, and tax-free compounding. That's generational tax planning, and that's what wealthy people do. Now let's talk about travel, because we all want to get outside and enjoy the sunshine. And this is an area where people either miss opportunities completely or they abuse it and create audit risks. So let's clarify how this works so you don't get in trouble. If you're traveling this summer and there's a legitimate, ordinary, necessary business purpose tied to that trip, portions of that travel may potentially become deductible. Maybe you're meeting clients, looking at investment opportunities, networking, meeting vendors, attending conferences, exploring expansion opportunities, or creating content for your business. The IRS generally looks at whether the primary purpose of the trip was business. One practical guideline many advisors use: if more than 50% of the days are business days, the trip may qualify as a primarily business related. And during those business days, you want meaningful business activity occurring. This is where documentation becomes critical. You want to keep your calendars, your meeting notes, your emails, your agendas, your receipts, your mileage logs, conference registrations, pamphlets. The more organized you are, the stronger your position becomes. So let me give you a real life example. Let's say a business owner travels to Scottsdale for 6 days. During that trip, they meet with 2 referral partners, tour a potential office location, attend a business mastermind, spend several hours each day handling business operations. Then maybe they spend an additional day or two relaxing by the pool or golfing. If structured properly and documented correctly, portions of airfare, lodging, meals, transportation, and related expenses may become deductible business expenses. But again, documentation is everything. You can't just post an Instagram photo from the beach and call it a business meeting. Summer is also a huge time for conferences, masterminds, seminars, and networking events. These can be excellent deductions as well if they are related to your trade or business. And here's another important point. You can add personal days onto business trips. A lot of people think the moment you enjoy yourself, that deduction disappears. That's just simply not true. You need to make sure the business portion remains dominant and properly documented. So if you attend a 3-day conference and stay a couple extra days, personally, there may still be deductible portions of that trip. Again, business purpose matters. Documentation matters. Intent matters. Now, let's talk about one of my favorite concepts called wrapping the weekend. This strategy surprises a lot of people. So let's say you fly to New York City. You work Friday, you work Monday, but Saturday and Sunday are personal days. You do whatever you want. You go see a show on Broadway, you attend a Yankees game. Under the IRS rules, if the surrounding days are legitimate business days where you actually work, those weekend days can sometimes still count as business travel days for purposes of determining deductibility. So in practical terms, you may potentially deduct lodging and certain travel-related expenses over the weekend, even though you weren't actively working on Saturday and Sunday. Now, obviously, this needs to be structured properly and supported with documentation, but it's a very real planning concept people overlook. Now, let's clear up another common misconception. Meals and entertainment are not treated the same under the tax code. This comes up constantly during the summer. People are hosting barbecues, taking clients to dinners, meeting referrals, partners, taking team members out, attending networking events. Generally speaking, business meals may still be deductible if there's a legitimate business discussion occurring. But entertainment expenses generally are not deductible anymore. So the baseball tickets, not deductible. Concert tickets, not deductible. Golf outings, not deductible. But food during those events may potentially qualify separately if properly invoiced and documented. That distinction matters. So if you're hosting a summer barbecue for clients or your team, and there's legitimate business discussion occurring, portions of food and beverage expenses may potentially qualify. Again, keep receipts and document the business purpose. And, with summer, that also tends to increase driving. People are traveling to conferences, meeting clients, looking at properties, visiting job sites, and networking more frequently since they can be outside. And many business owners completely fail to track mileage properly. That's a mistake. The mileage deductions can add up fast, but the IRS expects contemporaneous records. Use mileage tracking apps like Mile IQ, logs, calendars, notes showing business purpose. If you don't track it, it becomes much harder to defend later. And even if you're taking actual expenses where you're deducting your gas and your insurance and all of that stuff, you still need a mileage log according to the IRS. And finally, let's talk about the bigger picture here, right? We're moving through the end of Q2. We're heading into Q3 of 2026. This is actually one of the most important periods for proactive tax plan. Why? Because you still have time to make adjustments. You still have time to restructure compensation, accelerate deductions, set up your retirement plans, evaluate entity structures, manage your estimated tax payments, implement family tax strategies, improve your accounting and bookkeeping, track expenses properly, and prepare for year-end opportunities. The people who save the most in taxes usually are not the people scrambling in December or I'll say in the fourth quarter. They're the people planning consistently throughout the year. And summer is often when people become complacent, and that's where opportunities get missed. So hopefully today, I gave you a few ideas around hidden or overlooked summer tax strategies. Remember, the tax code rewards proactive behavior, but documentation matters, business purpose matters, and strategies matter. So don't wait until you're in to start thinking about taxes. The best tax planning happens before the year is over. If you found this episode valuable, make sure to subscribe, share it with another business owner, and follow along for more proactive tax planning strategies. And as always, if you want help building a customized tax strategy for your situation, reach out to our team. Thanks for listening, and I'll see you on the next episode. Have a great day. Bye-bye.